Gentlemen, we made it. We made it through Q3. We survived. I think everything went relatively well for the most part. Markets did relatively good. Liquidity, kind of remained the same, and markets pushed higher going into the end of the third and to begin this fourth quarter. So, want to take some time, spend about 15 or 20 minutes kind of giving our clients the outlook of what we're seeing for the fourth quarter, but more importantly, what we're seeing going into 2026. And what are some of those key drivers? So today's presentation, Luke, you came up with a creative name, the scaffolding to the structure. Can you explain a little bit what that means?
Well, this kind of goes back to the things like, if anybody's been reading our Substacks, we have a 4-stage model for economic growth. This kind of coincides with fiscal policy, what we're seeing in different sectors. Basically, so it's kind of a 4-stage economic cycle. Right now, we feel like we're in basically a stage 2.5 to 3 stage. Basically, stage 2 meaning that you're building the infrastructure. Everything's, whether it's the energy, the grid, the data centers, everything's basically being built for what's going to happen in the future.
Right.
And we believe that is kind of, we're squarely in that stage 2.5 area, but that through next year, we think, and going into 2026, it's going to be more the year of productivity, where it's time to kind of show that we're actually can make some money off all this CapEx spent.
Right. And for us, it looks more like the market's really digesting what's going on. But what's really happening is a little bit of front running of that fiscal acceleration that we see coming in 2026.
Exactly.
Yeah.
Yeah.
So, yeah. Anything on that?
No, yeah. I mean, right now it's it's interesting because as the market's ripping a little bit higher, it really, really feels like it's getting way out ahead of what should be coming down the line. It's kind of you're in this kind of flux between stage 2.5 and 3, and wringing everything you can out of this stage 2.5 build. Like, how much can this really go? I wish we had a better answer on precisely where we are, but I don't think anybody really knows where we are as far as how much AI build out is going to keep taking place. So we are definitely moving into a little bit more of a productivity and ROI kind of investment stance.
Right. And there's
Next
going to be
year.
some pros and cons to that, right? There's going to be some winners. There's going to be some losers, right? As soon as we start to really shift into that productivity ROI driven phase, the market may not just reward you any longer for, announcing $1 billion deal with XYZ AI company, right? There's got to be some kind of digestive period where they're saying, hey, this is great that you're doing these things, but in order for you to be rewarded from an investor standpoint, we need to see the ROI. We need to see the productivity.
Absolutely. I mean, Cristian has been tracking a lot of these things that could potentially have some kind of like some things, some pitfalls we're looking for, and some opportunities. I don't know if you want to explain a little bit about that.
Yeah, I mean, kind of like you said, right? Like it's hard to determine where we are in the cycle of continuing building out, right? Like, anytime you get on CNBC over the last 2 weeks, you kind of hear the news. We're in an AI bubble. How much is this expansion going to continue? And then you have CEOs like your larger companies like Meta and Amazon or Jeff Bezos talking about like, hey, maybe we will overbuild, right? But it's gonna be for the better of society, the better for the world if we do this. Zuckerberg said a similar thing about it, right? So, and then to Andrew's point, like, are you going to keep rewarding these companies for these massive deals that they're announcing? I think you'll see something similar to Q2 earnings where a lot of companies had front run the large numbers. So coming in line on your earnings and reiterating future expectations wasn't enough. And a lot of these stocks actually sold off on that, not just being enough based off people's expectations.
Yeah, makes sense. And we're really kind of to your point, to kind of pair off of that, is we're really in like this 2-phase cycle right now, right? And they're just at the point where they're intersecting and overlapping, where phase 1 was what Luke likes to call like that liquidity driven boom. And that can come from, the tariff tantrum period of end of Q2 to hopefully the end of this year, where you still have QT that's active with the Treasury. You still have these fiscal programs, which are largely created but not yet executed. And then you've got these investor trading around the issuance and what could happen in the future. And then we think we go into more of that phase 2 of this macro sequence, or in what you guys are calling stage 3, into this productivity driven type of expansion from 2026 to 2027. Can we talk about those two phases from a macro standpoint?
Well, if you mean basically what we've seen for a lot of this year has been kind of a treasury composition. I mean, the treasury has basically taken over a lot of the responsibilities of what the Fed used to do. They're really the source of liquidity, and they've been that way since I think Yellen was really um, one that really kind of made that significant change.
Right.
Um, we don't see that changing. We still see a lot of basically funding government operations with the short end of the curve. I don't see that's going to change. And like you said, with quantitative tightening, what are we doing? About 40, 50 bill per month. That's
Yeah.
still basically being used up for on tightening. So that's another resource for liquidity as well. One of the things that we're kind of seeing right now is some of the numbers that we track for liquidity have kind of basically moderated a little bit. They're not tightening, but we're kind of staying where we're at for a little bit. Um, and we've also basically what else has happened is the TGA has now been funded. And I think we've got up to what, 850. Was that what it is, Christian?
About like 15 billion. He kind of raised it up from the low 600s over the last couple months. So kind of caused a rolling correction where some of the stuff that wasn't working in the market kind of got a bump higher. Stuff that was working slowed down. But now that the TGA is built up to kind of the goal of the 815 billion, kind of primed to have those fiscal policies be enacted later this year and into 2026.
Right.
Yeah, that was the big buildup, right? So that we could, because again, like I said, when you see 875 on your balance in the TGA, that's another liquidity. That's another liquidity indicator. So we're really looking forward to the actually implementation of this administration, Trump's policies. So we're pretty excited about 26. Not excited about the valuations that we're seeing right now. So, but I think Andrew, that's what you said earlier, is that we're looking at this kind of transition from the build out to more of the productivity space.
Yeah,
Um,
and to your point, right? You just, and I just want to double click on what you said just a second ago. You're seeing this transition from liquidity dictating the market rhythm to, as we get into the end of 2025 into 2026, it's really going to be the fiscal policy that's going to be dictating the market movements. And that's the deregulation, the infrastructure, defense, energy appropriations that are all coming from the big, beautiful bill that are now going to be cycled through the economy fiscally. And in those key areas of plays that are still rhyming, what we're seeing today.
Absolutely. I mean, you
Okay.
think about like with oil and how much that affects our inflation, our prices, and that combining with these new policies,
Yeah.
so, which we haven't seen. Like we're seeing what oil's running in the 60s right now, right?
Yeah.
Next year, I mean, it wouldn't surprise me if you're pushing down into the 50s.
Right.
So all because of these different policies and everything kind of coming to pass.
Yeah. Beautiful. So let's talk about end of the year estimates. So I think we've been pretty consistent all year. So I would love for someone in marketing to pull up our clip in January and and show everybody what we actually said. So maybe a little bit of a rocky start. It wouldn't surprise us if we saw a 7%, 10% correction in the first half of the year. But we think as more some of these policies get put into place, it's setting up the economy and the markets for a pretty strong second half of the year and a pretty big finish, followed by two previous ones. So because we called for a correction of 10 or 15%. Yes, we got a 21, so we didn't get it exactly right. And we called for like a 12 to 15% year. So we've been pretty consistent. All of the other major institutions, major banks, all adjusted their year-end guidance, and now they're adjusting it back. So what are we seeing now? I think we were at the 6,800, 6,900 range in the beginning of the year. Are we still relatively around that range? Like where are we falling?
Absolutely. I think we're still looking, well, we still like the 6,800 target, but there's actual evidence out there with this momentum where it wouldn't surprise me if we hit 7,000.
Wow.
It's kind of a two-edged sword, though. I mean,
Right.
great, we ended this year at 7,000, but where we would be doing that with valuations really busting out and with creating almost like an imminent sort of correction that could be actually kind of painful, maybe
like
almost like a
Q1.
replay. Yeah, like a replay of this year.
Yeah.
Yeah, we've been pretty spot on with where we thought the market was going to go with the correction earlier this year. I think we're pretty spot on with where we think rates will wind down, and I think we might have been we. That's interesting when you think about rate cuts because I'm not sold that we're going to get 2 more cuts this year. I
Mhm.
think we're really not sure on that, especially with this government shutdown, and we don't know what the data is saying. I have a feeling that data could be a little bit hot,
Yeah.
so we'll see on that. But yeah, we feel pretty good about 6,800 to 7,000 range.
Great. And earnings growth around 265 for this year?
Yeah, Chris, you want to talk a little bit more how we came to that?
Yeah, so we're really around like 265, 270, with our price target around 6,800, 7,000. Like Luke said, that kind of puts us around that 24 times forward
That's
P.
really expensive, right?
Yeah,
And what I try to tell, families that we serve is, the market's like a balloon. The more full a balloon gets, the more susceptible it becomes to a dull object puncturing that balloon and letting air out. And when we have valuations as high as they are, that doesn't mean that they can't go higher. It just is stealing from future returns, at least in the short run. So, we all have seen the math of investing at all-time highs versus investing in any other day in history over a 3, 5, 10-year period of time. It's small basis points of a difference of returns. So if you've got that outlook, sure, right? But if you're placing new capital in the market at all-time highs with forward valuations at 24 times, just expect to kind of strap in the seatbelt because there's probably going to be that dull object that punctures that balloon and causes some of that volatility. Am I wrong in saying that?
Well, no, what the question would be is when, and
Right.
if we,
When?
and so what we try to do, whether we're watching credit indicators, we have a lot of indicators that we're watching, and nothing's really telling us at this point. There are some small signs, but as long as liquidity is ample, and it looks like
Right.
it's going to be, especially at the start of the year, this could carry on for some time. So and I don't see any change in the direction of liquidity. In fact, it looks like it's going to get greater. It's going to increase going into next year. And as long as liquidity is supporting the market, these valuations could get a little bit silly next year.
Okay. Yeah, I mean, what did the P multiples for the Qs top out at in 2021? Wasn't it like 32 times or something?
I'm not sure on that one, but I know it's probably it's to the point where.
That would be wild.
But I think that's the thing that you have to kind of suspend a little bit. It's harder for
Yeah.
us because we're really macro driven, and we still try to keep some semblance of rationality behind our decisions. You have to kind of suspend valuations right now. This is a liquidity driven market,
Yeah.
and where there's the liquidity, the valuations will follow, whether they're nonsensical or not, or like you said, you're really robbing from future returns down the road. Because you're
Yeah.
so front loading everything off right now.
Yeah.
But for now, though, that party can go for some time, provided that liquidity is ample.
Yeah, and we see liquidity staying that way. Obviously, there's black swan events that can cause, massive shifts in liquidity that you can't really predict. But, from our standpoint is, we see the market moving higher, not only through Q4, but through most of next year. That doesn't
Uh-huh.
mean that it goes up in a straight line, but, based off of what we're seeing from a fiscal stimulus standpoint going on next year, and even if the Fed modestly adjusts interest rates, it's going to push equity valuations meaningfully higher. So now let's talk about that stage 2.5 to stage 3, right? So where you're really titling it the build to the throughput. So you've got stage 2.5, you've built capacity, data centers, factories, grids, energy, different projects. Stage 3, though, is really monetizing that capacity. So turning the ROI, the throughput, and really creating that efficiency within those companies that drives margin expansion. Is that all relatively right?
Yeah, because I say this almost daily, multiple times a day. I'll let Christian kind of explain a little bit what you're talking about.
Yeah.
yeah. So I think over the last 2 to 3 years with this whole infrastructure build out for data centers, the grid, these large amounts that have been invested from the hyperscalers and from others, I think people are going to start questioning like, okay, what's the ROI that's being driven from these, and that's really what we're going to see in 2026. Add on the liquidity pressures, and then, or not liquidity, but continued liquidity, and then also margin expansion, fiscal policies that are going to incentivize companies to continue investing. But you're really going to see like continue investment into the productivity gains, right? Like, so how's Microsoft able to capitalize on their investment? How's Meta able to do it? Like, are they able to get better ad spend, reduce numbers, right? And then you tack on the labor market. Companies aren't really hiring right now. They're kind of keeping their workforce where it's at. So that adds on to productivity. They're able to expand their revenue without increasing overhead costs. Maintaining their capex relatively stable, gives a tailwind for these companies to continue growing. And then again, with tariffs and the administration pushing the onshoring of things like, hey, if you guys build XYZ here, you won't get affected by tariffs. So you're still going to see, I think, part of that stage 2.5 continue build out, but be more so until the push into productivity, gaining investments off this capex spend, and just continue growing
Well,
revenue.
think about like, so NVIDIA's loaning out their chips, right? Creating this circular demand. Now, all of this is great, provided that that people are using free, excess free cash flow to fund these operations.
Right.
But as what like a concern of ours was being like, we held Oracle for a long time, and we've recently gotten a little bit concerned with them because they're not funding it with free. They're actually funding it with debt now.
Yeah.
So no more free. Like, it's something if you've got, what, $15 billion or sitting around every quarter, that you can take 5 billion of it and put it into
that's
AI.
a good point. That was a prediction that somebody made, that they said, I read an article where they were talking about their prediction for next year is that some of these mega cap tech stocks, like Microsoft in particular is who they were talking about, actually starts issuing debt to invest in this CapEx. And that then becomes a problem, right? Because now you're incurring a cost to, like, a significant cost at a capital raise to do these investments. So on that topic, though, the 5 key themes, key core areas, sub themes that we're liking are digital workflow and AI ROI, right? Industrial automation and robotics, energy and grid reliability, financial tokenization and rails, and then healthcare productivity and bioprocessing. So maybe you guys can just talk a little bit about some of those sectors and why we like those going into not only the end of this year, but into next year. I'll let either of you guys kind of take that.
Well, let's start. We recently did an article on bioprocessing and biologics. Huge fan here. When we've been out in front of this for way too long, meaning that we were probably wrong. But the reshoring play, fueled by Trump, basically incentivizing these businesses to basically manufacture drugs in the States. We've seen this coming for some time, and he's basically telling companies like Eli Lilly, if you're not going to get tariffed, if you're planning on constructing these factories basically in the States. So there's a lot of incentive for folks to bring their drug manufacturing back home. We like that a lot. So, and then here's the deal too with the biologics. They clearly are the winners. That's where we're moving. It's a complex process. You don't just throw it in a vat and turn it and stir it up. So it's a huge process. So we like this area quite a bit. Robotics, also a huge fan, because what we're going to do, and here's a little bit of foreshadowing. We're going to do a piece basically on what does productivity really mean. Does it mean more jobs, or does it mean more job for robots, more for automation? So
Probably a little bit of both.
Well, yeah, it looks like it, because, well, that's why everybody's been using these metrics for labor and wondering why it's panning out the way that it traditionally would, is because corporations are becoming imminently more productive through these operations, and that's going to be further fueled with more automation, not necessarily robots, full humanoid robots, although that is coming. We think it's more just process improvement and robotics, kind of like more efficient factories, more robot arms, putting things together, things like that. Cristian, you have some other areas?
Yeah, and then I'll just touch on like the workflow automation, right? Like you talked about automation within like factories and manufacturing, but you could also see more automation within just like white collar jobs, right? If you're able to increase productivity of a employee by 20-50%, now you could have 2 employees that do the work of 3, right? So it
Right.
goes back to that whole no hire, no fire, where like you'll keep your workforce where it's at, but we're not gonna add more because we could increase our productivity just by the software automations, kind of creating those nuanced tasks to be automated without having someone to go in there and waste their time doing that now with these agents, agentic AI and stuff like that.
Yeah. And then lastly, let's just wrap around on the energy and like grid reliability, right? So all of these things, to create these funny videos that we see online that are AI generated, it draws power, right? It's going to inevitably have to come from somewhere. So a lot of infrastructure build out, a lot of investment, but also a lot of component pieces, right, going into the energy space that are going to be needing investments and upgrades to be able to continue to power this moving forward. I think
Mhm.
anybody that's really jumping on like the nuclear train, even though I've done it personally, right? I think is, it's years away, right? I mean, I think those SMRs are 6 or 7 years at minimum, right? If memory serves me correct. So we do have that as a component in the portfolio, but really geared more towards what, Luke, on the energy and grid side,
Well, we like the nuclear, but we're more of a picks and shovels kind of play with nuclear. Is that we
right?
love the SMRs, even the estimates I've seen that were the more robust or like still what maybe approval in what
Like
by
3 years.
2027,
Yeah.
and then even on these SMRs, maybe another year or two for at least for build out. So yeah, they're so far off. But in the interim, though, you don't ignore the potential there. So in that chance, we don't really we we're in and out of the SMRs, but we like a little bit more of the guys that actually make the materials that go into the SMRs and how they process it.
Yeah.
But the other areas that you were talking about is this is an interesting shift too, because each sector has its own basically stages. Um, for the last few years, and this is not a true new trend, the infrastructure has been built out. It began under Biden, where through the CHIPS Act and things, where we started really building a lot of infrastructure to support this new technology era. It's been going, but it's been going with actual build out. Now the
Yeah.
idea is to get how do you get your engines more efficient, your power generation more efficient, metering becomes more important. And again, this is so you see that the same thing is you're going from building out the structure to now let's make it more efficient and reliable because we just can't keep building this out. Nobody has that kind of money. So we've got the new infrastructure. Let's make it the most efficient that it can be.
Love that. Anything around the globe that we're paying particular attention to as we go into the end of the year and into next year?
Well, I mean, there's a lot of interesting thing happening in Japan. It looks like they're that I don't remember her name, the new PM. But
Right.
from what we understand, she likes to spend, and so that is when we're seeing that Japanese markets have been ripping, and we're a little bit invested there. We still like the infrastructure build out in Europe. You got to
Yeah.
kind of basically we feel they're a little bit more in stage two to stage 2.5, so they're behind us. So they still need to build the actual structure. They don't. We obviously know that Europe doesn't have the energy capacity because they have brownouts all the time.
Yeah.
So we still are heavily invested there, and we're watching some of the situations over in Argentina and Brazil as they get a little bit jumpy politically,
Yeah.
and see if there's some opportunity out there.
Love that. So it's not just US based, it's going on all around the world. And it's kind of like this global push for not only productivity, but also increases of ROI. So what are the biggest risks? Like what are we seeing? What are some of the headwinds? I think you're calling them the quiet headwinds. I know tariffs are still on everybody's mind. We still don't have deals with two of the biggest countries, right? China and India still there. So what other risks are we looking at for 2026?
Well, Chris, you want to take that one?
Yeah, so just going off the tariffs, real quick, right? Like, we still don't have the deals with China and India, like you said. Any possible retaliation or falling off on those deals can cause any headwinds for the market. You have, I think, later this month, the Supreme Court or early November is supposed to rule on if tariffs are constitutional or not, or are
Right.
they that to be like sector specific, so that'll be important for us too. And then we're really playing that QT will be rolled off later this year. So if you have like a continuation of QT where you're still pulling liquidity from the market, that might be a smaller headwind for the market there too. And then just inflation still a big aspect of it, right? When you add on the tariff impact and see like, is it just going to be a one-time increase? Is it going to be higher for longer rates, or are we going to continue increasing inflation? And I mean, gold seems like it's saying like, hey, inflation's coming, like
Yeah.
own real assets. So we'll wait and see.
My whole thing on gold is not really so much inflation. I think it's the lack of confidence in the dollar.
No, I agree with that.
I think you've seen more people shift out of USD into things like GLD all around the globe, right? I think that's a global move.
Hard assets.
Again, my thing on inflation is where is it? I've said this all year. Doesn't mean I'm going to ultimately be right, but I mean, we're now in October, and we haven't seen any significant increases in inflation. I know, Luke, you tend to say like, hey, it's being absorbed right now. I get that, but somebody's paying it. So if somebody's paying those increases that are actually in the current supply chain, we would see it somewhere across those publicly traded companies. Just haven't seen it. We also didn't see much of any inflation in the last tariff tantrum back in 2017 to 2018 to 2020, right? But I think some of that was masked by COVID, inevitably what happened there. So maybe it just takes time. But yeah, I agree. That is a big risk. If inflation comes back, then the Fed's going to be stuck between a rock and a hard place, a weakening jobs market, a slower economy, and higher inflation. You definitely don't want to own risk assets in that environment.
Well, it looks like, I think you're looking at gold, and here's the thing: the United States seems like it has no choice but to try to, deflate themselves out of the debt or grow.
Yeah.
So we're looking at the reflation trade kind of happening all over the world. So what does that mean, though? It's this own hard assets, because your paper money just not worth as much, and it's not going to be if everyone's doing the same thing. And this is one of the first times that I've seen where you have literally globally coordinated central bank efforts to do the exact same thing.
Yeah.
That drives risk assets higher, but you're also devaluing your your currency, and you're devaluing your base there. So I mean, I don't know what happens, but it's reflected in gold. It's reflected in Bitcoin, that people are looking for alternatives to the dollar and what will happen. That's kind of why we also like the rails for tokenization, and it's just a little bit more solid and less able to manipulate. So the other risk, though, that I would mention, though, is credit, and that's one
You're
of the ones
starting to see some cracks there.
Yes, and that's the little bit more concerning part to me, is that what we talked about earlier was how are you going to pay for all this expansion? Is it going to be higher debt? But we've seen some who blew up. Was an auto
First
firm.
Brands just blew up.
Yeah,
recently too.
and we've got a couple other ones that have blown up. And at what point do you keep being able to you're financing people by renting out your product, and you're financing the rental with your product. At what point does it stop, and you're not getting the return on your investment?
Well, and if you haven't seen, like, the Financial Times just drew a great diagram of like OpenAI's interconnectivity within the industry and NVIDIA's. I know somebody else I think someone from Goldman put out a chart on NVIDIA's interconnectivity. Yeah, I mean, like, when the music stops, right? Whenever that music stops, or whenever investor appetite starts to shift away from, hey, what's the true ROI on these investments? When you have an industry that's so interconnected like that, circa like the internet phase of the late 90s, early 2000s, everyone gets taken down. And I think Jeff Bezos said it perfectly. Yeah, it's not going to be justified that companies like NVIDIA may go down 60, 70, 80%, right? There's going to be clear winners there that come out of there. But yeah, when everyone's drinking from the same juice, especially in that AI space, when that juice cup gets pulled, it's pretty problematic. But yeah, so I saw on the First Brands,
Yeah, that was the company.
That's $200 billion of exposure alone just to Jeffries.
Mm-hmm.
I mean,
Now we've seen it in some of these multi-sector bond
yeah,
strategies that they've taken a little ding. And imagine if that was to get. So we're watching credit pretty closely. I don't see anything that says that we should be overly worried. But but you're right though. I mean, I've been in this long enough. I remember owning a company called Global Crossing. So and
sure.
they're building all this fiber all over the
What is
world.
the closest company today that's close to Global Crossing, Luke?
Wow, I not what? Who do you have in mind?
I don't know. I was just picking your
Well, it's
brain.
interesting. We saw there's an article on Verizon that came out today that they're expanding more fiber,
Yeah,
more fiber. They want it's a massive push. But what's interesting though about Global was that it was needed. Everything that even though they went under,
they just didn't need it
what
right
they
then.
built or no, who bought them? Global Crossing was like bought like level 3 communications or something.
Yeah,
And
all three.
we're now, but we needed it. We just didn't need it then.
Yeah,
So is that is that going to be the same thing? Well,
yeah,
we'll find out. And I think that's why this year you need to kind of test the waters on, is this investment worth it at this point, or do we slow it down a little bit? The other element though is though this has also become kind of like a space race and an arms race.
yeah.
You may want to slow it down, but if
You can't
China
afford to.
isn't going to slow down, you can't either.
Yeah. It's like the perception is reality, right? What does it
Yep.
cost not to have a private jet? It's like that kind of a concept. So I love that. So we've got some headwinds for next year, obviously. We went over those. And I just want to kind of close out that, this brings back to kind of our previous discussion of this pause before the push. So 2025 really being that pause, right? Where liquidity is still dictating the rhythm of the markets. 2026 we're seeing is the push where you get that fiscal execution that's paired with the productivity alignment. So in our opinion, and we're positioned for this, we are entering one of the most investable phases of this cycle. And not just because liquidity is abundant, but because productivity is finally going to start showing profitability as we get into 2026 and into 2027.
100%. No, I mean that's our whole year of efficiency and predicted productivity is 2026 for us. So now it may not be smooth, and
Yeah.
that's the scary part about when markets start ripping and you see stocks trading at 200 and 300x forward. Um, it may not be smooth. We may get a period where we digest a little bit in stock prices to kind of emulate what's happening with this change, with the move from stage 2 to 2, 5 to 3.
Right.
So it'll all kind of correlate because you're not just going to solve all of a sudden, hey, we're not going to buy any more NVIDIA chips and we're now going to buy and it's all going to be enterprise software.
Yeah.
Even though that word should start picking up a little bit, enterprise AI, and we'll see a little bit more of that because that's what we need to see to kind of validate the continued expansion of the infrastructure.
Yeah. And as investment managers, we would welcome a 5-7% pullback, right? Like those are things where we've got buy lists.
Yes.
We've got smaller position sizing on high valuation companies that we would love to up those position sizings in. And we would love that. So we've got the cash on the sideline to be able to do that. So great Q3. Let's have a good Q4. Thank you guys for doing this. If you guys have any questions, make sure you send us emails. Please, please, please subscribe to their Substack. They put so much effort, so much work into educating you guys into what they're doing in their strategy. Take some time, hit the button, subscribe to that. Christian, you're the man. Luke, love you, buddy. Have a great day. Let's crush Q4.
All opinions expressed by Andrew Whalen, employees at Whalen Financial, or any other podcast guest are solely their own opinions and do not reflect the opinion of Whalen Financial. Whalen Financial is a registered investment advisor. This podcast is for information purposes only and should not be relied upon for investment decisions. Clients of Whalen Financial may maintain positions in the securities discussed in this podcast.